This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasek from Trend Spider. We have
breaking news. What is up, Zinger Nation? How you guys doing? Happy Monday. Welcome back to another episode. I've got my man Nick Brown hanging out backstage, and I want to bring him on right away because, unfortunately, this is going to be one of Nick's last shows with us for the fall, at least. But that does not mean Nick's going anywhere. Of course, you can always find him on Twitter at newsbynick to get some more information. So without further ado, let's give Nick our special intro. Bring him on the show. All right, Nick, how are you doing? Looking snazzy as always.
Thanks, AB. We're counting down. It is so sad to count down for shows.
I know. Well, like I said, you're not going anywhere. You'll still be around. It might just be a little bit less frequent that we get to see you. So what's happening in the markets right now, Nick? What are the top headlines that you're watching?
I was going to say, we just got some new inflation data from the New York Fed. Shows expectations are moving down. So they say that their survey for their consumers in July puts the 1 year ahead of inflation, expected inflation at 3.5%. That's actually the lowest since April 2021 versus June's 3.8%. They say July expected home price rise moves to 2.8% from June's 2.9%. And the July expected rent price increase is the lowest since January of 2021. And that's actually good news, Aaron, just because that is going to show that, yes, inflation is coming down. And we've seen that in the latest CPI report, just because it ticked up just by 0.2% year over year. Inflation expectations are coming down, and that's actually going to give the Fed some leeway. As we get Jackson Hole, I believe, next week, that should have Powell reiterating that inflation's coming down, their 2% goal is coming in line with expectations. And that's really going to show for the bulls that inflation's coming down, and that's going to really push the recession off.
Yeah, I think right now, I mean, the Fed is kind of in this situation where it's kind of, imagine like you're getting in a shower and it's a new shower that you've never been in for the first time. And you don't know exactly how the temperature works, and you want to make sure it's not too hot or not too cold. That's kind of what the Fed's trying to do right now with the economy, where they want to slow it down to the point where inflation is like fully stamped out, but not too cold that it essentially causes a recession. So it's kind of just toying with that, nozzle till it finds the right temperature. And I think right now, even investors, let's look at CME's watch tool here and see what. It looks like about 88.5% chance, according to the CME Watch tool, I'll pull up this graph right here, that there's no rate hike at the next meeting. So there's still about an 11% chance, according again to the CME Watch tool, that there will be no hike, 88.5% chance that there will be no hike next meeting. There's an 11.5% chance that there will be another 25 basis point hike. So Nick, what's your call?
It is going to be very interesting because B of A has been arguing it both ways. They either say, and they just updated their new forecast, saying that they now expect a hike in November, a pause in September. And that's been the question on Wall Street, is how does September and November do play out? And so I think with the newest inflation data that we just recently got, and even PPI a little bit even confirmed this, I expect a skip or a pause in September. And there's going to be one final hike in November before we start getting some rate cuts. And so Goldman Sachs, Aaron, over the weekend highlighted this in a new note led by Chief U.S. economist David Merkel, saying rate cuts. And their baseline forecast calls for the Fed to start cutting the funds rate in Q2 2024. They're penciling in 25 basis points of cuts per quarter, but it could cut more quickly if it is more confident that the inflation problem is unlikely to return. What does that mean in simpler terms? Rate cuts every quarter after 2024 Q2. But if inflation continues to slow, what they're trying to say is it's going to hurry it up more quickly. They're going to start cutting more quickly. But if inflation actually tends to turn the other way, moves higher, which is what I'm expecting, and I'll give you some details on that in just a minute.
Okay, I'm ready.
They're going to stop the rate cuts. Now, why do I say inflation could turn higher? Commodity prices, and that's something not a lot of people are talking about. Is we have oil moving higher, and it is substantially moving higher, near, I think, $80, $84 a barrel. If the move in oil continues to move higher, near 90, $100 a barrel, that's really going to put inflation to a test, and I think that's really going to move inflation higher. The national average per AAA is 385. It's 389 in my neck of the woods, near $4. We will have to see how gas prices do, and I think gas prices are going to be the main driver, something that the Fed is really going to be looking at for the September meeting. Now, we get an inflation report. I believe we get a jobs report. We get a lot coming up between August, what we have left and through September, because I don't think the September meeting is until late September. I think 25, 26 would be the latest, would be the next Fed meeting. If inflation and if commodity prices do show an uprising in inflation, I think that's going to determine a 25 basis point hike in September. If not, I think they're going to say, hey, we've done enough for now, and analyze in November and give it one last 25 basis point hike.
Yeah, and Nick, I think to your point, looking at these gas prices here this is from AAA. You can just go to gasprices.aaa.com to look at these yourself, to follow along with if the class wants to follow along. But current average 385, like you mentioned, that's up about 30 cents from a month ago, and it was 356. Which is a pretty big jump for a month. I mean, if you go to a year ago, 395. So we're like basically we're at a year ago. Diesel has gotten very expensive in the last month. So 385 last month for a gallon of diesel is now up to $4.31. And the reason why diesel is important, I mean, obviously the regular gas is what we're all paying for out of pocket for our cars that we drive to work and whatnot. But the diesel price is what's being the diesel fuels being what's primarily used for trucks and whatnot, shipping goods. So whenever there's a price increase in the fuel, that's oftentimes passed down to the consumer, which could certainly mean an increase in inflation if this diesel price remains elevated. So I would just keep an eye out for that. If the diesel prices start to come down, maybe we will see some relief. If they stay high, then I anticipate a lot of those costs being passed down to the consumers.
Yeah, it's going to be very interesting to see the hard landing and soft landing coming out. Bloomberg over the weekend, and this was pointed out by someone on Twitter that I follow, Rahal. He works actually, I believe he works for Fitch, but not in the U.S. department. He's in another department, and he points out that Bloomberg is pointing out that optimism about a soft landing is growing, but many banks aren't convinced. So here are the banks and areas that they see a recession. Barclays, Bloomberg Economics, BNP Paribas, Citi, Daiwa Capital, Deutsche Bank, Jefferies, Mizuho, NatWest Markets, Numera, TD Securities, UBS, Wells Fargo. They all see a recession. Here's the no recession soft landing camp. Bank of America, they changed their call on August 2nd. Goldman Sachs, JP Morgan, they changed their call on August 4th. Morgan Stanley, Regions, Santander, U.S. Capital Markets. There's a bigger list of recession by the banks than there are no recession. And I expect, I'll take the other side of this. If inflation continues to come down, gas prices come down, I expect more banks and research firms to change their forecasts from recession to no recession soft landing. Yes, I'm arguing it both ways, but that's like a bull and a bear debate just with myself. And if needed, I really could write about it just because I have so many points you could argue for both.
Yeah, well, I think if you're bullish, you can kind of see it both ways. Where if gas prices and inflation start picking up again, okay, that's a sign of a hot economy. People are out there spending money. That's good. And the flip side is that if there is a slowdown in terms of spending, and gas prices fall and demand for energy drops, then that will likely mean that inflation also drops. And that means the Fed may be able to stop raising rates or eventually even cut rates. So if you have a bullish outlook, you can look at it either way. And it's basically the same with a bearish outlook where you could say, okay, yeah, sure, it's great. People are going out and spending money, but inflation's just picking them back up and the Fed's going to have to hike more. Or you could say, oh, yeah, sure, inflation's falling, but that's because people are spending less money. This is going to be, drive a slowdown in the economy, and there could be a minor recession. So I think, whether you're in the bullish or bearish camp, you can look at the outlook and say, and basically argue your way out of it. It's kind of like it's just you can create your own spin zone essentially.
You can, and it's very interesting because B of A's Savita Subramanian actually, they say today that they've been increasingly positive on U.S. cyclicals since April, and they're actually upgrading consumer discretionary to overweight from underweight, and they're actually lowering consumer staples to underweight from market weight. It just goes to show that spending is continuing to happen. Back to school spending. I believe it or not, AB, I start school next Friday, senior this year. I still have to go back to school shopping, and that actually has to happen either today, this week, or sometime next week.
There was you don't see as much like back to school. I feel like advertising deals as like back in the day. I feel like I don't know. Maybe it's just because I don't watch like cable TV anymore, but I feel like I don't see. Maybe this is like advertisers doing a good job and targeting their ads well because I'm clearly not buying school supplies this time of year.
But I do know, but back to school spending is supposed to be higher than it was last year. That's per a new Axios report just a week or two ago saying that more people are going to have to spend just because prices are a little bit higher than they were last year. And so spending is still happening. And then you have to factor in all the high schoolers or all the college students. Are they going to be grabbing Starbucks every day before class because of prices? As of right now, yes, we don't see any slowdown in spending.
Yeah. Just real quick, Nick, a sidetrack, pulling up WeWork's chart here. Gotta watch this today, up 18%. This was a stock that saw, a big short squeeze last week. You saw it get all the way up to around 33 cents after the company announced that it basically has substantial doubt that it's able to continue to operate and move forward. So basically, the writing on the wall, WeWork is, going bankrupt, basically kaput, and you still see these types of bounces sometimes in these stocks where people will buy it knowing that it's going out of business or whatever, and there can sometimes be these short squeezes. So up 16% today. I'm gonna wait and see how this kind of develops to see if this gains or loses traction throughout the week. Just looking at the chart right here, looking at the 2-minute chart, you can see the high we got to on August 10th. That was a few days ago. Looking a little head and shoulders-y to me right now, Nick. So I wouldn't really be a buyer right here. If I did want to get bullish I'd want to see us kind of break through this 30-cent level before I got bullish, because that would show me that it's got some legs to get there in the first place. But yeah, just worth watching today. WeWork stock up another 18%.
I was going to say, I did check out your latest article this morning on .com about Phil Mickelson and the money that, if he invested in stocks. I thought that was a very interesting article. AB, can you kind of just touch on this golfing, if you're a golfer like Phil Mickelson, and instead of just losing regarding the gambling and all that, investing stocks or bonds, we've had this debate. There's this debate now saying that you should probably put your money in the T-bills and that now, just because that's the new way to go with bonds and stuff instead of stocks.
Yeah, so here's the article you're mentioning. Here's how much Phil Mickelson would have made buying stocks instead of gambling. So this news came out last week that Phil Mickelson, gambled a bunch. I mean, it wasn't really a secret that Phil was a gambler. He's talked about it publicly before, and he even in his statement after this excerpt from a book came out, he talked about, hey, I've been open with my gambling problems before, etc. He denied part of the claims, but not all of the claims. And part of the claims that he did not deny was the fact that, or not the fact, but the alleged fact that he's lost $100 million throughout the last 30 years gambling. So I thought it'd be an interesting exercise. And obviously, if Phil has lost $100 million gambling, I mean, that probably means he's made more than that throughout his career through golf earnings and endorsements. I wanted to see if you just took that 100 million that he lost, not even the total amount of money that he has gambled, but just the amount of money that he's lost, and you put it into stocks instead of losing it on sports gambling. How much money would he have had? And so the methodology behind this on how I came to this number or to these numbers is, I couldn't just say, okay, say he bought $100 million shares of the S&P 500 30 years ago, because he didn't have 100 million 30 years ago. He earned that money throughout his career. So I said, what about, starting in 1993, if he put in 3.333 whatever million every year for 30 years, that gets you to that 100 million. So if he just made that $3.3 million investment every year for 30 years, his portfolio would be worth more than $560 million today. That's more than $500 million. Now, I wanted to be a little safer because in 1993, Phil Mickelson was a newer golfer on the tour. Maybe he's not making that much money, maybe not winning that many tournaments. Well, so then I said, let's say instead of 30 investment increments starting in 93, we do 20 increments of 5 million starting in 2003. So that gives him, by 2003, it's him and Tiger. He's one of the biggest golfers in the world. He's making a bunch more money than he was, when he was 20. So that's safe to assume that he could have been starting to put 5 mil away in 2003. And even with the more conservative estimate, that 20-year one, his portfolio still comes out to more than 300 million. So either way, it just goes to, I'm definitely going to think about this, Nick, next time I go to, put some money into my DraftKings. Maybe I'll think, hey, I should just buy the S&P 500 instead. It seems like a safer bet. No pun intended.
No, I mean, too, because we have a lot of this talk about, should you invest in bonds? Should you invest in stocks? I don't really know which is the safer one, because look, if you take a look at today, 10-year, it's up highest level since November 8th, and that's putting pressure on stocks. And we've seen that over the past few weeks, that if yields start to rise, markets start to tend lower and vice versa. I mean, is there really anything that can be a catalyst that says, all right, that can tame yields? Because we've seen that over the past few weeks, that market has been higher, yields have been lower in the morning, and then afternoon it's the complete reversal. Markets lose their gains. It's because yields continue to spike. I don't know which is safer to do. If you put your money in bonds, if you put your money in yields, if you put your money in stocks, you're still going to be losing either way.
Well, I mean, the safest thing you could do right now is just buy T-bills and get that guaranteed 6%. If you get exposure to that through a different way, then, it won't be as safe. But, I mean, that's like literally risk-free, free money. If you've got the problem, I think what that is for a lot of people that have longer-term outlooks, it's just not that enticing. But I mean, hell, why not? I mean, the free 6% is a free 6%. We'll put it this way: if you would have won that Mega Millions lottery a few weeks ago, and you walked away with say even just 100 million, and you bought 100 million worth of T-bills, 1 year bonds or 2 year bonds at 6%, you're getting paid $6 million a year to sit on your ass if you had 100 mil. So you take that with $100, you're getting paid $6 a year to just, do absolutely nothing. So I think eventually, if not already, there is going to be a lot of money that kind of, maybe would be going into the stock market that instead is just going to this fixed income world where, for that reason, you might just see a little bit lighter demand on equities throughout the next couple of years, unless there's a big, drop in the rates.
Yeah, it's going to be very interesting to see what happens with inflation this year, what happens with bonds, what happens with yields, what happens with the market in general, just because people are still talking about earnings, that they could have a downfall, even though earnings actually held up pretty well this quarter, better than expected. It's going to be very interesting to see as we get the consumer, a lot of the spending companies like Walmart, TJX, I believe Target, Home Depot, Lowe's, all this week. And that's really going to shed some light on, one, how are thefts doing, AB? That's one that I'm focusing on, that I haven't heard a lot of talk yet, just because they're losing money on thefts. And I think there was a break-in over the weekend with another theft at a local, I don't know if it was a Lululemon or one store on the news, that it just got ransacked, and that's money that's being lost. And so we will have to watch when earnings come out this week, how companies are managing. Are they upping security? Are they hiring more off-duty officers? The spending this week is going to be very interesting to see what are people actually buying. What's the most are people buying a new lawnmower, new laptops? Are they redoing their homes with all these, with this spending? It's going to be interesting to see how Target and Lowe's and Home Depot and all these companies do this week, to see what they highlight and what they even think for Q3 and Q4. Do they lower the guide, raise the guide? They're really going to set the tone for Q3 and Q4. And then we have NVIDIA. That's one to watch. They report next week. We're going to have to watch AI. I know they'll probably say it at least 100 times on the call. I'll be counting as I normally do, and we'll be tweeting out those numbers. But, there's a lot to gear up for as we head into this week and even next week.
Yeah, I mean, these earnings seasons are so fun. We're kind of, dwindling down here toward the very end. But, as we get into the fall, there will just be more and more activity going on in the markets. Of course, it's still kind of the end of summertime here. So Wall Street may be a little more quiet than it normally is. But looking around, other top stories, Nick, that we haven't gotten to yet, just going to benzinga.com here on the homepage. I hope it's
I was going to say,
homepage.
We could talk about Intuit's with the new PayPal CEO. Intuit's Alex Chriss is named the new PayPal CEO. This is the executive who runs the small business and self-employed group Intuit, Alex Chriss. He's the new CEO of PayPal. That's according to the new board, new memo that they announced. Chris will take over of PayPal's longtime CEO, Dan Schulman, beginning September 27th. Schulman became PayPal CEO after the split from eBay in 2015, and he announced a plan to step down from the role by the end of the year. He goes on to say, Chris said in a release Monday, quote, "I am proud to take the baton from Dan and thrilled to have the opportunity to work with PayPal's talented and committed team to build on PayPal's remarkable history and draw on its unique compatibilities to deliver outstanding products and services to businesses and consumers." PayPal's board said Chris was chosen for the role out of a pool of 9 candidates. The selection process began in February. The board member says they were impressed by Chris's leadership at Intuit, particularly as he steered the company through its $12 billion acquisition of the marketing platform MailChimp. It just goes to show PayPal. I mean, Aaron, look at that chart. Look at the spike and look where it's at now. It's really not getting a big boost today on its new CEO announcement. We tend to say that these new CEO announcements are short-lived, these for the stock, and that's really playing out today. PayPal not really going anywhere for the long term.
PayPal's stock, yeah. I mean, one of the things with PayPal that I haven't seen that much coverage of, I know I've talked about it on the show before, with these stocks, Square and PayPal. There's this new payment processing software. Honestly, our next guest might know something about it. But here in the United States, called FedNow, where essentially the Federal Reserve is putting out kind of their own like public version, government version of what PayPal offers. And so if you're a business and you have FedNow, which is coming in, and it's like the government, so you figure it's pretty safe, and it's undercutting PayPal and Square, lower fees, then if you're a commercial account, then you basically have no reason not to be using FedNow. And that might be one of the reasons why when you look at these charts, I mean, look at Square and Block's charts. Those two stocks have not participated in the 2023 rally whatsoever. And it's not like growth is out of favor. I mean, you look at other companies. I mean, I know ARK's going through kind of a rough streak right now, the past 10 days, which we can get to that after our interview. But I mean, ARK, is up. Let's see. ARK stock, I'm going to guess it's up 30% year to date, up 39% year to date. So ARK's ETF is up 40% year to date. Meanwhile, Square's stock is, sorry, I keep calling it Square. It's not Square anymore. It's Block. Block is down about 7%, and PayPal is, I'm gonna guess, pretty similar, down about, oh wow, down 15%. So that's a big red flag. I mean, you could be bottom fishing if you're really like gutsy and you want to, dig the bottom of the barrel here. But it's clear as day that the market is not into these stocks right now. And again, I'm not saying it's because of this Fed now thing, but that could be part of it. There's other things going on as well. But I'm honestly, again, I'm curious if our next guest has any thoughts. But yeah, Nick, thanks for walking us through that the CEO story. I mean, it's not the we've had a lot of executive turnover. Tesla last week, the CFO left. Tesla announced some new price cuts. I think yesterday in China, so we can get to that too real quick after our interview.
Yeah, I was going to say they're building a new data center. We can touch on that after.
Okay, yeah, but yeah. So you see here, stock is trading down about 2.25%. Trading lower after the company cut some Model Y prices in China. You can always spin zone however you want it. Like, I mean, here's the thing with Tesla is like I do hope they keep cutting prices and put out like Elon's talked about putting out like a $25,000 Tesla for a while, and I don't know if they've ever actually gotten it that cheap. And I'm sure the Tesla like fanboys and investors will find a way to spin it however you want. But typically, if you're a company and you're cutting prices of your product, not a great sign in terms of demand. But and I think China just has a lot of growing competition right now between NIO, Xpeng, Boyd, you name it.
Yes, there's some competition, and who will win in the long term? It's probably going to be Tesla, given they already have a good fair share of the market, EV in the long run. Ford is trying to catch up AB, but I don't know. There's a lot of people partnering with Tesla because of the EV charging stations. Not sure if that's going to help them in the long run. It should, but I think Tesla is going to be the winner long run. Can they get vehicle prices down enough that average Americans can buy today? Someone that like could be a school teacher for a public school district, or someone that's working at a local grocery store, not someone that has to make 3, 4, 5 figures in the long run.
Yep. All right, Nick. Well, I'll bring you back on after our interview. We are going to talk to Pagaya's CEO, Gal Krubiner. So without further ado, let's go ahead and give Gal our very special Zinger Nation welcome. And when we get back, we'll be talking some fintech, some banking, some AI, all exciting. How you doing today? Thank you for joining us on Benzinga Live.
Thanks a lot, Aaron, for having me. How are you today?
I'm good. Thank you for asking. Where are you joining us from?
So actually today I'm joining from Tel Aviv, but mainly I'm based in New York, so traveling in between these two.
Wow. I've actually been to Tel Aviv before. Beautiful city, and I know it has a bustling kind of startup and tech culture there that's very unique to the city.
Appreciate you saying so. Definitely a place to visit.
Yeah, well, maybe we'll get to that in a minute. So, you're the CEO of Pagaya. Can you walk us through exactly what the company is, what you guys do, and I know it's kind of some complicated behind the scenes banking stuff. So if you can try to make it in layman's terms, like almost like you're explaining it to a kid.
I will try. I will definitely try. So basically, let's start with the mission. Pagaya is trying to help banks and different lenders to bring more consumers into the mainstream economy by allowing them to get access to credit and to financial products that they deserve. Now, the way we go about it, as you alluded to it a little bit, is a little bit different. Instead of becoming a lender, we actually created a network, an AI network that is connecting to every lender and allowing them with a seamless API to be able to approve more consumers as they come to their website, shops, or what have you. Maybe the best way to describe it is to give an example. So when a person is going to one of our lenders, it can be Klarna, it can be Ally, and is asking for a loan in a dealership, Ally, while deciding maybe not to give the financial product for that person, the loan, will send all the information to us via instantaneously in the API, and we more likely than not will be able to approve them and to provide them a loan. Now, the beauty part of that is that the person who's going to get the loan is going to get it from Ally, and the interaction he's going to have throughout his loan life is going to be with Ally. So basically what we have created a ability for that borrower not to get rejected and to get a loan from a very respectful financial institution. And at the same time, we allowed Ally not to give up on a consumer and a customer and make them as theirs. So that's really what we do, just in a very big scale.
So essentially, correct me if I'm wrong, kind of acting as the intermediary between the bank and someone, that's looking to take out a loan, but doing so, using, state-of-the-art technology and, AI to make this a very instantaneous process, something that probably used to take a lot longer than what you guys are doing right now.
Correct. We're doing that in less than 0.4 seconds, the approval. And on the other side, as you said, there are institutional clients that are looking to deploy capital into these very unique consumer credit assets, especially in times where banks are shrinking their balance sheet, as what we saw with SVB and few others. So big institutions are stepping in and actually providing that consumer credit. And Pagaya, being a two-sided network, both for the investors and the lenders, are actually facilitating these transactions with an AI as the engine behind.
Got it. So there you go out there. If anyone out there is watching and you're like a person that is looking through loan approval, trying to approve loans and stuff, 0.4 seconds, that's what you got to beat to be able to beat the computer. So I don't know if any humans out there can do that, but you never know. So is it similar to like what an Upstart is doing, or is, what are the differences between Pagaya and Upstart?
So the main differences of the business model. While their business model is to lend to others, they could be considered as a lending partner for us, and therefore they will connect to us and we will help them extend more credit to more people. Now, the similarities, as you said, are the fact that we are in the space of consumer credit, in the space of auto loans, etc. So different both business model, same markets as such, and they definitely could be a partner on our network as we scale up.
So potential partner, not necessarily like main competitor.
Exactly.
Got
well
it.
said.
So walk me through, I know you guys recently released earnings. Can you walk me through some of the highlights of those earnings and what investors have to look forward to?
Yes. So from my perspective as CEO, I was very proud of the quarterly earning we have managed to achieve. We exceeded all of our outlook, both on the network volume, which is the way we capture how many loans we provided. We both on the revenues and on the EBITDA, the two-sided network concept that is balanced in between the investors and the lenders is actually helped us to tremendously navigate the macroeconomical turmoil, if you will, and brought us to the ability to continue to overbeat that metric says, as such that we have raised our EBITDA guidance for the year to a $40-50 million from a $20 million. So a big increase because we have the confidence as we look deeper into the year in our ability to do that. And a lot of that is because different lenders in the US are tightening their credit box and actually sending us more applications and more opportunity for us to tap on to convert that into loans that are going eventually into the institutional clients. Maybe the last sentence I will add on that is our economic and operational leverage is starting to kick in, and that's how you're starting to get to the positive EBITDA and the ability to produce more revenues for the company. We're measuring that by the FRLPC, which is the fee revenue less production cost, that reached into the bandwidth of 3 to 4%, which is how much net revenue Pagaya is creating from every $100 of loan that we are creating, which we feel that this is a healthy number that as we scale and grow, we'll be able to translate into hundreds of millions of dollars of EBITDA.
Got it. So, can you walk me through this, B2B to C business model? Because I understand that it's kind of a unique business model, and how that might differ from, other players in the space.
Yes. So the main difference is that while we are helping the consumer and our mission is to provide more credit to the consumer, we do not have any interaction with the customer or the consumer. So the B2Cs are actually the lenders. We are becoming behind them as the B2B to them, that is enabling the B2C and facilitating that through institutional clients. So the one leg removed allow us to have a unique vantage point of all the data that we are seeing from so many lenders, while keeping all the lenders equal and not having the B2C relationship as such with the consumers.
Got it. That makes a lot of sense. Basically, just kind of white
Life
labeling, taking
labeling, yes.
all that off the bank's plate and saying, hey, you don't have to worry about, this tedious process and doing this. We're better at it anyway. We can do it for you. Um, Gal, I mean, right now, the stock, went up after the earnings report, has come down a little bit from there. Like, what do you think investors on the market are I guess I shouldn't say missing right now because the stock's up more than 100% year to date. But it's still trading a ways off of it of when you guys went public via SPAC. I mean, do you think part of that is kind of being grouped in with these other SPAC companies? Like the whole SPAC group kind of got battered there. Do you feel like Pagaya is kind of unfairly, grouped in with that?
Yeah, so obviously, I like everyone has his own perception of valuation, but I will definitely say that being in the SPAC process was not helpful from that perspective and brought us not to the best place. And the other piece for that is technicalities of like sellers that were on our stock that needed to clear the way in a world of low volumes, as you will alluded that post SPAC. We definitely saw since the last few months that volumes came up and a lot of interaction and interest of investors. We are getting definitely very great feedback of people seeing our work, the consistency, the ability to deliver throughout macro cycles. So I think what you saw around May, etc., is definitely an inflection point. That people recognize the gap in the valuation and starting to get into the stock and to see the potential of what that could become years ahead. And we are excited to provide that value to the shareholders, to the investors. We actually initiated a shareholder letter to be able to articulate even better what are we doing this quarterly earning, and we hope that will attract more and more investors to see the beauty and the value that Pagaya is bringing as a two-sided unique AI network.
Yeah, and I mean, so with right now the Federal Reserve, may increase rates again in the United States. It may pause. There's kind of a lot of potential market volatility, not necessarily right now or yet, but if the Fed does hike again, or if the economy starts to slow down and some people are worried about a recession. If the markets do get turbulent again, do you have a plan to try to kind of maintain value in the stock and keep investors happy?
Yeah, so I think again the uniqueness of the ability to have two-sided is that like you have ability to react to macro very well and very rapidly. There is always one side that is a little bit more on demand or oversupply. Now it's definitely lenders looking for more funding, and therefore they are the one that are driving most of the value. And in other days, it could be the investors. So based on where we are going with the economy, Pagaya has many levers to be able to do that. And I think the last 4 quarters of meeting or exceeding the expectations of investors is a very strong, prudent, proven ability to that. And obviously in the last 6 years or 7 years since the company started, we have managed to experience in the crazy world that all of us are living, anywhere from a COVID to wars and everything. And Pagaya performed and will continue to perform as such and we have a very strong confidence in that capability.
Yeah, I mean, yeah, man, you're fine. Like you've been through the SPAC, the rally after the SPAC, the down, now this 100% rally from the thing. You're like, hey, man, I've been through it. You know, whatever happens, like we're just gonna keep trucking along. So you know, the two biggest stories I'd say on Wall Street this year so far, or at least I'll say two of the biggest, maybe not the two biggest, but have been, you know, AI and this whole kind of rally that's been driven by AI. You look at stocks like NVIDIA, AMD, et cetera, you name it, basically anything that has to do with AI has rallied this year. I don't need to tell you that. And then the other thing that's been a big storyline has been regional banks. And you're kind of, you know, involved with both. Yeah, so you know, you talked about Ally Bank, you know, potentially, you know, companies like Upstart. But what about these smaller banks and places like maybe credit unions? You know, how is Pagaya working with those? Are there plans to work with those types of institutions more?
So I just want to emphasize that all of it is coming with a lot of work, and many Pagayans across the world that are working day in, day out to deliver that.
Pagayans? Is that
Pagayans,
what you call the employees?
Yeah, that's how we call it.
I like that a lot. I like that.
Appreciate
We call Benzinga. We're zingers. I'm a zinger.
So I'm a Pagayan,
Okay.
and as a Pagayan, as you said, we had a lot of periods, but like it's important for us to continue to deliver, and I want to make sure that people appreciate that it comes with a lot of prudent work and understanding where markets are and what is the unique value proposition of our product that we have created both for the lenders and the other side. And part of it is the credit unions. And actually earlier in the year, we partnered with Angelo Gordon, which is a very big asset manager, and helped a credit union to free up some capacity on the balance sheet, giving all the movement in interest rate, etc. And we facilitate that to the institutional clients. And we do expect that to be a repeatable thing, that there are different banks that are having some headwinds that are looking to offload part of the balance sheet, and we are working with institutional clients to be able to facilitate that. And you're right, we have a tailwind from the bank situation, which is one. The second one is people starting to appreciate more and more the power of AI, while it has many implementation. And frankly, another one that people are a little bit less familiar with on the institutional world, which is the movement from PE, private equity, into PC, private credit. So while these banks are moving out, actually big asset managers are moving in. So there is a big movement of investment of big asset managers from the PE world into the private credit, which is super interesting for us and where we are standing in the cycle.
Interesting. Yeah. And I mean, with the banks specifically, I mean, like, how, from what you're seeing on the inside, does it feel like the regional bank crisis that people were super worried about that we saw after Silicon Valley Bank and First Republic collapsed? I mean, does it seem like some of those fears are subsiding? Is there as much withdrawal pressure as there was in those, you know, months? I think that was in March, maybe 5 months ago or so now.
So I will divide the answer to two. I think from a big event of like a collapse of a bank or a super distressed situation, I would say that the odds and the fear has muted a lot. In the same time, as a headwind, I think it's something that is going to stay with us for a while. So higher interest rate, deployment of big amounts of deposits money in a low interest rate environment are going to put some pressure on earning on banks, and therefore will push them to become more prudent, tighter credit boxes, and less ability to provide credit to the consumers. And that's exactly where Pagaya comes in, and that's why we feel very strongly about our ability to onboard more banks down the road, and that our unique tech product that is designed to be very well integrated in the white labeling, as you mentioned, into these type of institutions will bear a lot of upside for both the banks, investors, and our shareholders.
There you have it. Well, Gal, this has been a fantastic discussion. It's been great to have you on and learn more about Pagaya, learn more about the Pagayans too.
The most
And
important.
yeah, the most important. And hope to have you on again, in the future, anytime you guys have updates, and if you or any topics, anything like that. And I also got to mention we do have we have a Benzinga FinTech Deal Day coming up later in October, I believe, and so maybe we can get you on a panel or something like that, because it sounds like you'd be a good fit for someone to be at that event.
Thanks a lot, Aaron. It was really a pleasure, and appreciate and love the discussion.
Oh, you as well. All right, well, enjoy the rest of your Monday. Thanks again for taking time out of your busy day to join us.
Thanks a lot, Aaron.
All right, guys, there you have it. Gal Krubiner, the CEO of Pagaya, ticker PGY, trading on the NASDAQ. Always good to get some fresh CEOs on that, to have them on for the first time, meet new companies, meet new leaders. Let me bring my man Nick Brown back on, see what he's been watching, and we'll take this little lower third off the screen. Nick, how you doing?
I'm doing well. Fighting with Twitter right now. As TweetDeck is now not loading for me, so just more steps as Twitter does not load again.
Yeah, I mean, it's tough. I think if you're in the camp of, oh my God, look at how fine Twitter is after laying off 80% of the people. I think the past couple months have been rough for you, because there's been a lot of things that have been like broken or just not really working that well. With that said, I do 100% agree that probably most big tech companies do have too many employees. But to say you can just lay off like 90% of the engineers at Twitter and nothing bad's going to happen, like, that's clearly not been the case. I think, like most things, the truth is probably somewhere in the middle, where it's like, hey, maybe you don't need X amount of employees at all of these companies. But you don't, there's actually a really good book about it. It's called Bullshit Jobs. I believe the guy's name is David Graeber, and it's all about how, the biggest companies essentially have grown and grown and grown and gotten bigger and bigger and bigger, and basically like creating useless jobs to just grow in terms of like headcount. One example of it, which is the most fascinating, is if you look at, healthcare, the amount of like doctors has stayed pretty constant, or like grown, steadily with the population, but the amount of executives in hospitals, like people that aren't even doctors, don't see patients, but get paid hundreds of thousands of dollars a year for overseeing the business side of hospitals, has grown exponentially to now there's like, it used to be like one executive for every 10 doctors, and now it's like 1-to-1 executive. I'll try to find it. Nick, while I try to find that, take me through some headlines.
I was going to say, Goldman's out with a new note just a few minutes ago saying that, quote, our 12-month recession probability of 20% remains well below consensus. Bloomberg, I believe, has a survey going. I believe they're like 60-70% the recession is going to be occurring in the next 12 months. I do not think we're going to be getting a recession, but before I digress into that, I don't know if you saw, Aaron, but Linda Yaccarino had her first interview since taking the CEO role at Twitter. That happened last week. I believe that happened Thursday on CNBC. She goes on to say that basically Twitter, or now that we call it X, is at the best ever with all these things going on. I actually disagree with that. I think Twitter is not going so well. A lot of scammy ads, a lot of functions not working. But, this rebranding just goes to show that a lot of people are still going to call it Twitter, not X. For an example, I don't know if you're familiar with Heinz Field in Pittsburgh. That was renamed, I believe, last year, a few years ago, to Acrisure Stadium.
Yep.
I don't know anybody that calls it Acrisure Stadium.
I do.
Come on.
I respect brand deals. So, I mean,
but
if Heinz, okay, look, Nick. I mean, all right. Heinz is hold on, let's read these. Kraft Heinz. What's the stock symbol for that?
KHC, I believe.
KHC stock. You're right. Kraft Heinz is a $42 billion company. If they cared about Heinz Field, if they cared about the stadium, they would have paid for it. I think they said, hey, Big Ben's gone, so are we.
Easy Mike in the chat says, no, it's Heinz Field, LOL. I agree. Just like I think someone pointed it out on Twitter over the weekend that if someone came in and bought their town and renamed it, they're not going to call it the rename. They're not going to say, hey, we're going to call it the new renamed town. They're going to call it the former name of the town it was, just because people are familiar with it. People don't say, hey, let me go to Meta. They
what
say,
about as a journalist? Shouldn't you call it by the name of the company if you're writing about it or if you're reporting on it?
You can call it both. A lot of people are now saying Twitter, formerly known as Twitter, now is X.
Okay.
They cite both. But even too, when you go to search it, TweetDeck, Elon Musk now calls it X Pro. But up top, it still says TweetDeck.Twitter. So you have to kind of just call it both. So yes, if I'm writing an article as a journalist, I'm going to say, hey, I'm going to Heinz Field, formerly known as Heinz Field, now Acrisure Stadium. I would include both names just because I don't know if that's the proper thing to do, but that's what people are familiar with and people are known about. But Tesla, they're cutting prices, and we touched on this earlier. If they cut prices, if they continue to cut prices, I think that benefit all of us, just because someone who's working a grocery store job, a city worker, or someone that's not making a lot of money, they're not going to have 45, 50, 60, 80 grand to buy a new Tesla. But regarding this data center, AB, Tesla is going to build a new first-of-its-kind data center. That is according to a report from Electric. The automaker is hiring staff for it and snapping up some existing data centers. Data center business is now massive with a market size of more than $250 billion. Of course, they didn't explain how the data centers will be. They're first of a kind, which is not something you expect in a job posting anyways. But it just goes to show that Tesla is trying to get into the business of like cloud, as like Amazon's in, Microsoft.
I know I'm not an expert in this, but it seems like they're a little late for that. Like it seems like Amazon, Google, Cloudflare, whoever it is, like already has a pretty good foothold on that. I think I don't know. This is just might make me sound like an Elon hater, but like Elon has been right. This sounds like the opposite of an Elon hater at the beginning, but just hear me out. Elon has been right, like, and way ahead of his time on multiple things. Obviously electric vehicles, Tesla, him buying into that company and taking it over and turning it into what it is today. As well as, he founded OpenAI like years and years ago and knew this. And, sure, maybe he got pushed out of OpenAI or something might have happened. And it sounds like he's got some beef with Sam Altman. But, I think Elon seems to be kind of chasing some of these things that maybe he hasn't been, or, like if Tesla had gotten into this 10 years ago, it'd probably be a huge business line. But now they're trying to get into data centers after there's already like established players and whatnot. It's the same thing with AI. He was in OpenAI. Something happened, he got pushed out, or him and Sam Altman had a falling out, whatever. He had no more exposure to AI. It starts blowing up. Now he's starting his own AI company. And it's like, dude, like OpenAI has been at it. OpenAI has been at it. You're going to start a brand new one and try to compete with that. So it seems to me like he's kind of, he's like a dog chasing squirrels here, where he's trying to find his next like great idea. Because, maybe I'm not saying he's bored of Tesla, but he had that idea. He did it. He brought he brought Teslas to where they're at now.
Yeah, I was going to say regarding that too, it's going to be very interesting to see, are they going to eventually be building more plants? How's Tesla going to go about trying to deliver more EVs in a more timely manner? We know that, he talked on the conference call that prices can still go up. They're watching inflation. They're watching how gold and silver and how all the commodities do. But also the price. Is the price eventually going to come down at a near-term level, a good level, that they're going to normal average Americans can start buying and they don't have to keep saving. But, if we could turn to Michael Burry, his new 13 filing is out, and this is the season for them. If you could throw up a chart of Alibaba, according to what I've seen, according to his 13F filing, according to what I'm seeing, he dissolves a share stake in Alibaba. That's according to the new SEC filing.
Wait, that means he's sold?
Yes, and these are as of June 30th.
What the hell? All right, what's Baba Stocks doing? Because I'm a big not really a big holder of Baba, but I am a holder. So anytime you got a big investor selling while you're holding, you're like, oh, what the heck is going on here? All right, looks like we're not getting the. I know it's all over Twitter, so let's try
Yes,
to. Sorry, all over X.com. Let's try to find it here on X.com. Let's see if anyone's making any posts about this.
I
Wait,
am.
Burry. Michael Burry portfolio is now made up of 93% SPY and QQQ puts, 1.6
Yes.
billion in total. All right, so he is, he is, call him a jockey. Why? Because he's massively short.
He's out
All
of
right.
Baba. He's out of JD.com. So it looks like a lot of the China names he's out. And remember, these are as of June 30th. These aren't really timely. So again, he is an active day trader, as many people point out. So these, of course, have probably changed. And so this is a downfall of when we get these 13F filings, AB, is these aren't really the current holdings of these particular asset management companies. These are as of June 30th. So a lot of these have changed, a lot of them, especially if they're active day traders. But again, we'll be watching Warren Buffett will be getting his latest filings this week. So we'll have to see how he is doing here in the United States, what he's buying locally, what he's buying internationally. He's invested a lot in Japan. So we're going to have to watch that. But just goes to show that China, a lot of people are really skeptical of, just because what the leadership over there has been trying to tell journalists and economists, that you're not supposed to be talking negatively about them, that you only have to report the positive. And right there, that's propaganda. You should really report both sides of the story. And we've been even highlighting this too, how China really has been seeing a downfall, that economic activity isn't coming back as expected. GDP isn't coming back as expected. And so they are trying to silence journalists, just saying you're only supposed to be reporting one part of the story, one side of the story. I'm probably banned from China from going in there. You're probably banned from China. A lot of journalists and economists are probably banned from China. I don't have any plans of traveling to China, but just goes to show that one side of the story only fits what they want to think and what they want people to know over there, instead of trying to report both sides of the story regarding the protests and Foxconn Group. We talked about that earlier in the months this year. But, China isn't really coming back as all as expected.
Yeah, I don't know. I like to think I'd still be allowed in China. Just to, we got to wrap up here, Nick, running a couple minutes long. But this was the chart I was talking about earlier. This is part of a Mother Jones article. So, this is the growth of physicians in green here. This is the amount of growth you've seen in doctors from 1970 to 2015. So this is a little old. I think I saw this chart like in college. So that's why I always have these weird things like that, Nick, that you learn in class and they just like stick around for you for a while. But you can see the managers here. So in the 70s, it was okay, a lot of doctors per manager, and then the whole managerial class for executives, hospitals, kind of making it more of a business, has grown tremendously throughout the years. So something like this, if you were like, yeah, I mean, we should cut 10% of the executives in the hospital workforce around the country, I'd probably be like, yeah, because, they're not the ones seeing patients or doing anything. Maybe they'd be more productive in another part of the economy. But that's kind of, I think there's a lot of those types of inefficiencies in our economy. But you don't really see it in the numbers. I mean, the GDP just keeps going up and we're doing fine. But I think
4.1% currently, according to Atlanta Fed. That was last week.
Wow. All right, Nick. Well, thanks as always for hopping on the show. We will be live tomorrow as well as Thursday. So hope to have you. I know next week will, be one of the last ones for the fall. But like I said, you won't be going anywhere. We'll still be getting some good Nick Brown content. That we need that. So Nick, with that, I'll ferry you adieu. Have a great rest of your day.
Thanks. You too. See you tomorrow.
Yeah. TTYL. Ta-ta for now. All right, guys. It is 12:33 on the Eastern time zone here in Michigan. As you can see behind me, nice sunny day here. Something really weird happened this morning on my weather app, my Apple weather app. It said next Wednesday here in Detroit was supposed to be 109 degrees. And I screenshotted it, sent it to people, made jokes about global warming, all this stuff, told people in the office. Turns out it was like a glitch. Next thing, I went to open my phone and it just wasn't there anymore. So don't know what happened. But alrighty, y'all. We'll be back tomorrow. Peace and love, y'all.